class, we are beginning our Module 2, Starting and Growing a Business. This module contains two chapters, Chapters 4 and Chapter 5. This chapter, we'll begin with Chapter 4, Options for Organizing a Business. Our learning objectives for this chapter is define and examine advantages and disadvantages of sole proprietorship form of organization. First of all, you're going to have to know what it is, and then what makes it good and what makes it bad. We're going to identify the types of partnerships and evaluate the advantages and disadvantages of those organizational structures. We're going to describe the corporate form, which is very popular form of organization, and again, the advantages and disadvantages. We're going to define and we're going to discuss at length the advantages of mergers, acquisitions, and leveraged buyouts. What are they, what they do, and when is it a good thing and when is it a bad thing? So let's get started. First, we are looking here at the introduction, and it really gives you a good idea of what's going on. Let's just really roll down really quickly. A sole proprietorship is one person, one owner. Proprietor means owner. So it's one owner structure, meaning the only individual that's going to be reaping the profits of the business is the actual owner of that business. And for tax purposes, it's going to file an income tax for an individual. The liability is unlimited. If a mistake is made, if a customer is dissatisfied and goes to remedy the situation through legal means, the sole proprietor and his or her personal assets, are subject to unlimited liability. A partnership is an agreement between two or more people. They are easy to establish. It's extremely easy to establish. The partnership does have unlimited liability in most instances, because the general partner will have to deal with liability from anyone who wants to sue. His or her personal assets will be up for grabs, basically, if someone wants to sue. Again, individual taxes are paid on the profits or losses of this organization. Although a partnership prepares a information return, the partnership as a whole does not pay taxes. It is a pass-through entity, and the partners will be subject to taxes if they have profit. Corporation is probably a little bit more formal structure. The legal liability is very much limited to the extent of that shareholder's contribution. It's subject to double taxation, and this is talking about a regular C corporation, and the number of shareholders are limited. S corporation is kind of a subset of the corporation in that it is a partnership in terms of taxation, because the S corporation does pass through all of its earnings, profits to the shareholders. It has a limited number of shareholders. It is a legal entity, which means the liability to the shareholders is limited. The individuals cannot be attached, garnished, or anything for the actions of the corporation as a whole, which is very much the same as a corporation. LLCs, really much like a partnership, they are members, basically, unlimited number. They avoid lawsuits simply because they have a limited liability, and that's the whole point of that organizational structure. Underneath this chart here on the little pie, I'm just giving you an idea of the number and percentage-wise sole proprietorships and partnerships and corporations, and their relative importance to sales, net income, and number of partnerships or sole proprietorships or corporations. Now, a sole proprietorship is a one owner. The business owner is one individual. This does not mean that this individual doesn't have employees. They could have 50 employees, or they could have 100 employees. But when it comes down to the equity stake in this organization and the profit and losses, only one person will take those. And it is a very, very big part of the U.S. companies. Now, as far as advantages, it's easy to start up. It is very, very, you can do anything you want. It's high level secrecy as a private organization. You keep all the profits, flexibility, and control totally in the hands of the owner. Government regulation is minimal. That's very, very true. Taxes only paid one time. That's very important, and particularly is paid at the individual rate, which is very much lower than at the corporate rate. The disadvantage is always going to be the unlimited liability. Anybody can come after a sole proprietor, even their personal assets are at risk. Funding for this proprietorship is limited to what a individual person can acquire, whether it be debt financing or their own personal assets. The owner really is going to have some diverse skills because they have no other individual to share those, to share the skills. So basically, this owner really has to have a good idea of what they need to do and the skill set to get it done. Success is directly linked to the owner. That means if the owner has some significant limitations, it's going to show in the organization and in its ability to grow and be profitable. Sole proprietorships are small businesses. Generally, most organizations do start off as sole proprietorships simply because they're so easy to form. There's no paperwork involved in terms of legal documents. It's you and only you, but you're responsible for everything, and you take all the risk and the financial obligations of that corporation, that organization. Partnership is a little bit better simply because you get an association of two more persons who carry on as business owners, and they do it for a profit. They share in their talents, in their resources, in their time, and running that business. It is not all for one. That being said, the advantage also with a partnership is very easy to establish. It is taxed as an individual, so the taxation is much smaller, but it is going to be larger than a sole proprietorship, but then smaller than a corporation, generally speaking. Now, partnerships most must have a general partner, which means this person has unlimited liability and will share in both management and liability within the organization. Limited liability partnerships have one general partner, and the rest are limited partners. Limited partners basically do not run the company, and their liability is going to be limited to how much money they invest in the organization. Legal documents are needed for a limited partnership, but not always needed for a basic general partnership. Although agreement is important to establish who, what, when, and how much profit will be split among the partners, and how to handle dissolution, but it is not required. Partnerships are easy to organize. They do have more than one person, therefore they have availability of capital and credit. They have a number of individuals, so their skills and their knowledge is going to be much broader than a single individual. And decision making is not all that complicated, particularly when you have someone that you are very much aware of and you have a relationship with. So decision makings are is well straightforward. Intervention by the government is going to be limited. Again, this is a partnership, and it is taxed as an individual because the profits and losses is going to be passed through to partners. But partnerships have to deal with the unlimited liability, and they are going to be responsible for each other's decisions, even if you do not know them. That's why it's important to have an individual that you are very much aware of and you have a strong relationship with, because you're going to be responsible for the decisions that you make as well as the ones that are made by your partner. Now, partnership agreements will be dissolved if one or more partners leave, or if a new partner wants to add. So that's important in consideration, and it actually can be costly because you have to dissolve the corporation and restart another partnership, when there is a change in ownership. It is not easy to sell a partnership interest, but there are ways you can do that. You can deal with that, but it is not an easy thing to do. Profits may be uneven, and that's really depending on the agreement among those individuals. External funding is not easy to grasp, but you again can get the funding that you need, but it's not straightforward. You really have to. It's much more formal, and it's just an issue because partners don't want to give up any ownership stakes, so they'll more than likely have to acquire debt from loans and line of credits or their personal finances. So there are going to be, partnership doesn't pay taxes on their profits. It is a pass-through entity. They do pay taxes for employment for their employees, but nothing for their profits of the organization. So partnerships are a very good way to establish your business, and most organizations that are professionals, meaning medical doctors, accountants, and lawyers, generally will be partnerships. They're not allowed, generally speaking, to be corporations because the nature of their work, they want these individuals to be accountable for um, their their decisions, and they want them to have some legal liability if they make mistakes. So therefore, generally speaking, corporations are not allowed for medical doctors, like CPAs, and for attorneys. But other than that, it's a pretty good opportunity for individuals who do not want to be as formal in a corporation but do want to have more than one person working with them. A partnership is a great way to establish your organization. Corporations, we have two types. One is going to be a C corporation, which is a regular corporation, and the other is an S corporation, which is a subchapter of a regular corporation. The regular corporation is a legal entity. It is separate and distinct from its owners. It can and transfer property. It enters contracts, can be sued or sue in court. It is a legal entity. It is separate and distinct of its owners, and assets and liabilities are not part of their owners. Owners are called shareholders in corporations, and they are a majority of the um, U.S. sales and income within the United States. They provide stock as a certificate of ownership in these businesses, and the owners of this business are stockholders, and they are only liable to the extent of their investment in stock. Organizations can provide dividends, which is the residual profits of the organization, or they may very well just deal with the appreciation of their stock value over time. Corporations are obviously chartered by a state. They are required to issue legal articles of incorporation, paying a fee, as well as establishing their bylaws and board of directors. State then issues a charter to that organization. If the organization is housed within the same state that is incorporated, it's a domestic corporation. If the corporation is residing in a state other than its incorporated state, it is a foreign corporation. Alien corporations is going to be a corporation outside of the nation in which it was incorporated. Therefore, McDonald's, which is a franchise, a type of organization, it will be considered an alien corporation within Israel or another nation. Corporations obviously can be private owned. Their stock can be only owned by the personal or private individuals. It is not public, and their information about their finances are not made public. Initial public offering will allow an organization or corporation, particularly, to make available their stock to outside individuals. That it means going public, and that is another way of raising money. Corporations raise money primarily through the issuance of stock, whether private or public. They issue stock in order to gain equity in financing in their organization. They also finance their organization through their revenues that they generate and retain, as well as debt. Corporations are many. Quite frankly, most organizations do start with corporations simply because of the legal protection that it provides the owners. So public corporations, where you can buy their stock or trade it on the open market. Quasi-public, well, that would more or less be operated and owned by the government. And we mentioned that with monopolies. Regulated utilities and monopolies are generally quasi-public corporations owned by the government. And generally, it's not about making a profit. It's more or less protecting the public and ensuring that fair competition and pricing is to the advantage of the consumer and not to the corporation. Nonprofit organizations are also corporations, but they focus on providing a mission through a service, and they're not owned by the government. In fact, they're not owned by anyone, and they're generally receive revenues through donations as well as providing a service. An organization that is incorporated generally should have and must have a board of directors who guide and provide long-term objectives for the organization. Generally, a board of directors may not or will not or probably is not actual employees. Sometimes they are, but their overall mission is to hire the corporate officers, and they can be liable for mismanagement. Organizations structured as a corporation can issue two types of stock. Generally, it's going to be common stock, which are the actual owners of the organization. They vote. They have the right to make decisions within the organization. They are the, in fact, owners of the organization. They obviously receive dividends. Preferred stock is going to be these individuals will not have voting rights. They do not run the company, and they are not considered the owners of the organization. However, they do get preference with regard to dividends. Corporations have to deal with, particularly you're talking about the C corporations. This does not apply to S corporations, but they have to deal with double taxation. There is some cost involved in establishing a corporation. Not too expensive, depending on legal cost as well, but it does cost a little bit more money than a partnership and a sole proprietorship. They must provide some disclosure information, and owners and managers are not always the same, and they may not have the same goals. So you'll have to deal with those kind of conflicts in a corporation. That is not necessarily the case in a sole proprietor or partnership. Obviously, the advantage is going to be limited liability. Stockholders are only limited to the extent of their stock investment. They are not to be seized. Their personal assets are not to be seized if the corporation is sued. Transfer of ownership is quite easy. A stock certificate does have like a check, a way to transfer ownership of that particular stock. It is a perpetual life, which means that unless it is officially dissolved, corporations live forever. And perpetual means just that. It's a perpetual life. It is never going to die unless you literally dissolve it. It has to be dissolved in order to be no longer a corporation. Funding is far easier because you can then sell stock to raise money and to expand your organization. Again, corporations are subject to hostile takeovers. Well, when an organization is selling their stock to the public, an individual or company can try to buy more stock and take over the company. Generally, organizations that have no desire whatsoever to have any outside ownership, a hostile takeover is practically non-existent. It's generally, we're talking about corporations that have their stock made available to the public. Now, joint venture is going to be in a sense of a partnership, but S corporation is going to be a corporation because it provides you that wonderful protection against legal liability, and in the double taxation is going to be non-existent simply because it is a pass-through. A pass-through entity does not pay taxes like a partnership. It is very much like a partnership because it only provides an information return, and all of the ownership profits and losses are going to be passed through to the owners of that organization. So an S corporation is a great opportunity for an individual to have a corporation without having to deal with the double taxation with a regular corporation. S corporation has significant restrictions in terms of revenues. I think you cannot exceed over $5 million, and you have to have over less than 100 shareholders. So those limitations are not too onersome, and most organizations that decide not to be a partnership elect to be a corporation because it's kind of the best of both worlds. LLC corporations, many of those will be like doctors and lawyers simply because they have to be exposed legally if they make mistakes, and doctors and lawyers and accountants generally have to be held responsible as individuals for what they do, since they are CPAs licensed and medical doctors as individuals. So an LLC is an alternative for those type of organizations that cannot be a traditional corporation. Cooperatives and co-ops, also, these are organizations or people come together that provide some kind of I would say service. And one co-op I think would be a homeowners association. If you live in a townhouse community, they will organize a corporation, if you will, that will be responsible for maintaining the grounds, making certain that all of the fees are paid, and handling the business activities for that particular co-op on behalf of all of the homeowners within that area. Individuals can be have be owning their business, because some organizations will allow them to um, purchase stock, and then that would give them a vested interest in the organization and it being successful. These employee-owned businesses are just that. They are corporations which give the employees the right to buy stock at a very reduced rate. Organizations do get larger. Sometimes they get larger simply because of all the mass sales and the growth of that business. However, businesses do grow in other ways. They grow through mergers. Mergers will be a combination of companies to form one new company. There are three different types, and here are they located on your screen. And depending on the type of business and what their outcome is for that organization, a horizontal merger may be more appropriate than a vertical merger, or a conglomerate merger may very well be the best opportunity for that organization. But again, I think mostly looking at it from a legal perspective, you should get counsel from your attorney to see that which one is the most advantageous for your organization. So as we talk about business ownership, what our organizational structure that is best for your organization really depends on what you're trying to accomplish. Knowing the advantages and disadvantages of each organizational structure will give you some idea as to whether or not a sole proprietor is the best option, or a variation of a partnership in the form of S chapter or LLC, or LLM, or just becoming a corporation. Again, we're talking about what is the best way to handle your organization, what are the decisions that you'll need to make, and what is the information that you'll need to know in order to make that right decision about what type of organization that you want to establish. Also, there are leveraged buyouts. This is not a common occurrence, but there are a group of investors where they'll come in and they will try to acquire a company by using the assets of that purchase company, or to guarantee payment of a loan. This happens mostly when you're dealing with a merger or an acquisition. It's generally not happening as much in the past, because it's a way that organization, the owners try to avoid a takeover. But this is certainly not something that's been happening quite a bit in recent years. As you read the chapter, you can think about things like, why would I choose to be an S corporation? What am I trying to, what advantage will I gain if I choose a partnerships organizational structure versus a sole proprietorship organizational structure? So as you go through the chapter, try to differentiate among the different types of corporations and see if you can find out if there's an example of one of them. Or if you would want to be an owner of an organization by buying stock, would you rather be a preferred stockholder or a common stockholder? With this chapter, I think you will be able to answer that question and be able to be satisfied with your answer, and also be in the position to reap the benefit of that decision. This chapter is probably the most fun of the chapters, simply because many of us at one point in our lives have decided that we want to operate in a business, and the nuts and bolts of operating a business starts with the type of organizational structure that you want to create. So as we go through this chapter, think about businesses, think about what your future might hold with the business, and see which organizational structure would best fit your need. And again, thank you very much for listening, and I will see you in the next one.